So now we're going to talk about contribution margin. And I think this is one of the most useful ways to think about business, just to change your perspective about business. So contribution margin and its measures. What we talked about in financial accounting is a lot of times we talked about inventory and capitalizing our costs into this inventory account. And that's great for a consistency metric to compare against other companies, where we know that companies are all using a similar methodology for capitalizing their inventory and assets. And that way we can compare Walmart to Costco, for example, when we're making investment decisions. But as managers, it's not as helpful as something called contribution margin. Contribution margin is non-GAAP, important to know. It's non-GAAP, but it's extremely useful from a internal management perspective. And all we're looking at is the selling price per unit minus total variable cost per unit. So what am I saying here? It's really my profit per, it's not my GAAP profit per unit. We call it contribution margin per unit. But if you think about it from a layman's term, this is what a layman would think is as profit per unit, where, let me open up a calculator, where if we're selling a product for $100 and our variable cost is $20, we have what a layman would think is $80 of profit per unit. Now, us as more advanced finance professionals, we would know, well, we haven't considered our factory costs, we haven't considered our depreciation, we haven't considered our investments in fixed assets. Have we allocated our overhead? All these things are true. Have we allocated our rent? All of these things are important, but at the end of the day, for determining overall profit, but at the end of the day, it's very important to know how much money do I make for each extra unit I sell, because it's contributing to both my expenses, my fixed expenses, right? Like if I work as an accountant or as a consultant for $100 an hour, and I know that it only costs me $10 an hour to do the work. So $100 minus 10. I make $90 an hour in contribution margin. Now maybe I have $10,000, not $10,000, let's say $1,000 in expenses, right? Let's say I have $1,000 in a small office and I have to pay for electricity and I pay for some advertisements, website hosting, and software. And let's say that's $1,000 a month. Those are my fixed costs. I can easily determine how many hours I need to work to break even, right? I just divide this by my contribution margin. I only need to work 11 hours to break even. And then we can do that with any kind of business. That's the benefit of contribution margin, is how much money does each hour of input contribute to our fixed costs and then ultimately our payout to investors. So if I want to decide if a business is profitable or worthwhile to me, I can decide, well, I want to make $120,000 a year. Let's say, what is that in a month? A month, that's $10,000 a month. So how can I make $10,000 a month? Well, I know that to make $10,000 a month for myself, I would want, I need to consider my fixed costs, which we assumed are $11,000. I know I make $90 an hour. And so I'd have to work 122 hours in a month. And we know that there's about 4 weeks in a month. So that's about 30 hours a week. So I need to work about 30 hours a week at $90 an hour in order to make my profit of $100,000 for myself and to pay for all my fixed costs, right? And so that's the concept that we want to build. That's why contribution margin is useful. We're looking at our selling price minus our total variable cost per unit. And then our ratio helps us compare investment opportunities. And this will happen to you. It happens to me all the time, where companies will come up to me and say, hey, we'd like to have you as an advisor. We'd like to have you as a consultant. And I need to compare it. My time is very valuable and very limited. So I need to compare opportunities and determine where is my highest contribution margin ratio? Where am I going to make the most money towards my other costs? And so the way you do this is just take your contribution margin divided by your selling price. So my selling price was $90 an hour and my contribution margin was 80, or 80 divided by 90. So I have an 89% contribution margin. And you can do that for any other business. But let's say someone else comes to me and says, hey, I'll pay you $120 an hour, but I need you to drive an extra hour, and it's going to cost you an extra $10 in gas. And I can decide based on a percentage what is a better investment. So even if I'm getting paid more, it doesn't necessarily mean a better choice for me individually if my contribution margin percentage is less. So that helps me make internal decisions for how I'm going to invest my money, how am I going to invest my time, and my resources, not just for myself, but for my employees and for my resources. So really useful. And I expect you all to be able to calculate contribution margin, as it's going to also be the basis for our break-even analysis. And so I'll open up a Google Sheets eventually and kind of walk through some more of these calculations, and memorize these formulas. And so on a quiz, I could definitely ask you, if your selling price is $120 per unit and your total variable cost is $30 per unit, what's your contribution margin? And then what's your contribution margin ratio? I could ask you those questions. Or I might say your contribution margin per unit is $20 and your selling price is $50. What's your total variable costs? Please be able to manipulate this in any way for answering a quiz. So using that, let's talk about break even. So what's the break even point? Break even point is the sales level at which the total costs equal total sales. So that means, hey, I have broken even. We hear this all the time if you ever watch Shark Tank. Like, when can we make sure that we've at least recouped our losses? This is near and dear to me because when I owned my recording studio, I didn't know any of this stuff. And so if I did a break-even analysis, if I knew this material earlier in my life, I probably wouldn't have gone into that business because I had such a high break-even point. But we have to determine when will we recoup our losses from our sales, and how long will that take?